All right. It is a wet day here in South Florida, and I don't know if you can hear the thunder in the background, but it is an economic storm that is happening right now. And I want to share exactly what that is because CPI numbers came out. They are super hot. It is absolutely creating tremendous upside pressure on the bond market, and I want to go deep on that. But Zillow has confirmed, Redfin has confirmed, Black Knight has confirmed, and Wall Street has confirmed that the housing market has entered the Twilight Zone. Now, I just did a video yesterday talking about how the Fed wants to crush you, it wants to crush me, it wants to crush the consumer, it wants to crush the economy, it wants to crush the housing market, the labor market, the credit markets, the lending markets, with the ultimate goal of reducing inflation. And yet inflation has skyrocketed. Inflation accelerated in September, with the cost of housing and other necessities intensifying pressure on households, basically wiping out any gains that many have received and ensuring that the Fed will continue to aggressively raise interest rates. Consumer prices rose 8.2% in September, and yet excluding food and energy, core inflation jumped, which is clear-cut evidence that the Fed rate hikes have done little to nothing to cool inflation pressures. Core inflation jumped 0.6% from August to September, and it's jumped 6.6% over the last 12 months. That number is the highest number in 40 years. And the stock market, which prices these things in real time, sold off hard on the open. They did not like these numbers. And as of the making of this video, which is midday, the stock market has come roaring back. Now, the question is that a real rally? Is that short covering? Is it a short squeeze? Yet to be determined. Here's what I do know. The Fed does not care about daily stock market fluctuation. So anybody pinning hope on the Fed not acting hawkishly is confused. But here's a critical point that everybody needs to know. And it's that today's report is the final report as it relates to inflation before the November 8th midterm elections. And inflation and spiking prices have created a tremendous amount of fear, uncertainty, and anxiety across the board. And I don't think it's a surprise to anybody when I say that Republicans blame Joe Biden and congressional Democrats. But let's put all that to the side for a second and address the majority. And the majority of Americans right now have a pretty dim view about their finances. In fact, according to a new poll put out there by the Associated Press, 46% of people right now describe their financial condition as being poor. And so while inflation skyrockets, it's highly unlikely that the Fed is going to change any of their plans to keep hiking rates aggressively. And it's already boosted its key short-term rate by 3% since March, which is the fastest pace of rate hikes since the 1980s. And the intended consequence of these rate hikes are to raise the borrowing cost of mortgages, auto loans, and business loans. Mortgage interest rates have gone through the roof. They're north of 7%. The last time I checked earlier today, I believe it was something close to 7.46%. And if you don't have perfect credit, it's way worse. It's closer to 8%. But auto loans, business loans, and lines of credit are through the roof. And just look at large retailers to get a sense of what's likely to happen in the future, because they're pivoting hard, offering all kinds of discounts for holiday shopping season. And they've got stockpiles of clothes, furniture, electronics, and other goods. And Walmart's getting in front of this too. They're offering massive discounts on everything. And Target began those same deals earlier this month. But rents and housing costs have not gone down much at all, in spite of the fact that the Fed is trying to crush this market. And healthcare, education, and veterinary services are rising rapidly in price. And along with that, grocery bills, utility costs, and insurance have skyrocketed too, in spite of the fact that many of the supply chain issues are easing. And the Fed is going to crush us. And the Fed doesn't care. They're going to do what they must do in order to tank the markets. But is the housing market really about to crash the way everybody thinks it is, or is it simply just entering into the Twilight Zone? I mean, the truth is, higher mortgage rates generally do not bode well for the housing market. And we've just seen some of the steepest increases in history. And right now, most home buyers are facing massive sticker shock. And affordability is worsening at the fastest pace on record. And the spreads on mortgages and benchmark interest rates have reached levels unseen in decades. And the volume of new sales is slowing at a faster pace than even during the aftermath of the global financial crisis. So does that mean home prices are about to collapse? Well, that's one possibility, but the other is that the housing market has just entered the Twilight Zone. James Egan, who is Morgan Stanley's U.S. housing strategist, recently cut his price forecast to show a year-over-year decline in December 2023, but he's expecting a fall of only 3%, which is a far cry from an outright collapse. The real problem that we're facing right now is that we're in uncharted territory. Well, it's factually true that mortgage rates have shot up astronomically, decreasing affordability exponentially. But unlike 2008 and the bursting of the subprime mortgage bubble, right now there are very few forced sales and therefore very little inventory. The listings of existing homes available for sale, we've got that data going back to the early 1980s. It was never lower than earlier this year, and we've been increasing a little bit from the bottom for the past 3 months. But the truth is, listings and inventory is still tight, which keeps home values supported. Now, to truly understand where home prices are trending, there are 4 things to look at: supply, demand, affordability, and available credit. And while supply and demand don't tend to change quickly, affordability and credit move very quickly. And that's exactly what we're seeing right now. And right now, the overwhelming number of homeowners are locked into fixed rate mortgages. And because they've got a ton of equity, most people feel insulated from the coming shock. But for most homeowners today, in order to sell their home, in a lot of instances need to take out a new mortgage that might be 200, 250, 300, or 400 basis points higher than their current mortgage. And there's no shot in hell they're going to do that because it's not in their best interest. And so we're entering into a twilight zone of uncharted territory where measures of housing activity deteriorate rapidly while prices stay firm. So as you can see in this chart, house prices surged after COVID and exceeded the peaks from even the early 2000s. And each of the last 16 months represents stronger growth than the previous record prior to the global financial crisis, which naturally raises the question of whether such rapid run-up in home prices are sustainable. Each of the last 16 months would have been a record in year-over-year growth if we were comparing it to 2004 and 2005. We have significantly surpassed that when you add mortgage rates up over 300 basis points since the beginning of the year, which means that the monthly mortgage payment on a median-priced home is up over 50% year over year. It's jumped from 3% in 2020 to north of 7.5% today. That's the highest since the early 2000s. But the spread between mortgage rates and benchmark interest rates, measured by the 10-year U.S. Treasury yield, is markedly higher than it used to be. And there are a ton of investors who have shied away from buying mortgage-backed securities, and that's helped contribute to the higher cost of borrowing to buy a home. And while all this is happening, the Fed has stepped away from the market as it winds down its balance sheet. So the big buyers are gone and volatility's through the roof, which has led to a gap in spreads. And affordability is deteriorating at an unprecedented pace, especially when you compare that to the average income in America. In this housing market twilight zone, especially as far as affordability is concerned, is whose affordability just deteriorated. Most homeowners have fixed rate mortgages, and most of them refinanced when rates were super low over the last few years. Meaning affordability is not an issue for these homeowners, but it's a major issue for new buyers. Most homeowners' affordability is locked in for the next 30 years. They're not going to see their affordability deteriorate at all. But prospective home buyers are screwed if they were relying on lower rates. But in this high interest rate twilight zone that we're in, home sellers have no motivation to sell because they're locked into these low rates. And so we're right back to the supply-demand dynamics that drove the market higher all year. And supply and demand will govern the price of every home. And frankly, I don't see much motivation for most folks to sell their home unless they have to or want to. And well-capitalized, affluent people can do whatever they want when they want to. But that's not who's going to feel the pain the most. The economic pain that Jerome Powell has said we can expect in the future, which again signifies to me that he doesn't think what we have right now is anything close to pain. When that pain is felt and people and families must make hard choices of whether to feed their family or pay for their mortgage, and they're living on the fringe or the margins to begin with, it will create forced sales. It will create foreclosures. It will create short sales. It will create distressed sales. And until that happens, we are in the housing market twilight zone. Now, I hope you enjoyed my video and found this content valuable. If you did, please subscribe to the channel, give it a thumbs up, share it with a friend, and check out my next video because I suspect you're going to love it a lot. And until next time, peace.